we see that and we resonate with it, where we just think that, at some point the bottom is going to drop out, yet it never really does.
And creating a plan. Your plan should guide your decisions, not your emotions and your knee jerks.
So the real market magic doesn't happen when the market goes up. It actually, when it goes down, if you're contributing,
1,000%.
because you're gaining so much more traction. Speculation is something that we don't do. Slow and steady wins the race. Diversified portfolios that stand the test of time, and staying disciplined and being that prudent investor.
Welcome back to Wade Through It All. I'm your host, Abigail Wade. I'm a financial advisor and a certified financial planner with RM Wade & Company Ltd. of LPL Financial. As always, joined by my co-host, Robert Wade. He's a financial advisor, the president of our firm, and my dad. Hey, Dad, how you doing?
Doing great. Really looking forward to today's episode of the pod. I'll tell you, this is a conversation a lot of people need right now because markets are choppy. And so this is super, super important.
Yeah, I really couldn't agree more. Today, we want to talk about what to do when markets get messy, when things might feel uncertain, there's headlines out there, and your account balance may not be moving in the direction that you want.
Yeah, this is where the emotions of investing take over.
Yeah. And
it really is relevant. I mean, we've been kind of very, very choppy so far this year in the beginning of 2026. So, how do we navigate some of those waters to keep on track, to keep on course, and what we need to do to accomplish that.
Yes, exactly. So we'll walk through how to stay calm, what to avoid, and how to keep your long-term plan in focus and intact, even when things may feel uncomfortable. And before we even get into what to do during market volatility, like what we're seeing now, I think it's really important to step back and talk about why this feels so hard in the first place.
Yeah, it's a deep dive into, it's not just really about money. It's really more about behavior
100%.
and why, as investors, there's that uncertain feeling, that uneasiness feeling that does come along with investing, and how to get through that.
Yeah, 100%. So when I was going through my CFP training, there was a whole section dedicated to behavioral finance alone. And this is basically how our emotions and biases impact financial decisions. And this is where it really shows up when we have choppy markets. So let's get into here's what's happening behind the scenes in your brain when you're looking at your investment accounts or anything, any of your account statements. So the first sort of vocabulary word we'll get into are, words, I guess, loss aversion. And the definition of loss aversion is how people feel losses more strongly than they feel gains, roughly 2 times as much. So, in terms of an example, so if you look at your account and you see a $10,000 loss, that feels way worse than seeing a $10,000 gain on your statement. And that's why downturn can feel so intense for some people.
Yeah, it's throughout my career, I've experienced this so much, where clients are exuberant. There's actually a Simpsons episode where they were talking about Enron, and they're taking the roller coaster, and it's like, oh, we're all going to be rich, and then they go down and they're like in the poorhouse, which is a house that the roller coaster goes through, and we see that and we resonate with it. Where we just think that, at some point the bottom is going to drop out, yet it never really does. Obviously, it's horrible to anybody that's, that was heavily invested in Enron and lost everything. But the reason why that person lost everything with Enron is because they invested solely in Enron. They didn't have a balanced portfolio. They didn't have diversification. They put all of their eggs in one basket, and unfortunately, that wasn't a good basket to invest into.
Yeah, 1,000%. But if you're in a well-diversified portfolio or you're working with an advisor, it's important to keep, obviously, the long-term, picture and plan in focus for yourself. So when you do see that loss, or you do see, and just to be clear, you haven't, and Warren Buffett says this, you haven't lost a dime until you sell.
That's exactly correct.
We are going to dive headfirst into that sort of idea and statement a little later on in this episode, but it doesn't, take away from the fact that when you do open up your account, you do see a statement and, maybe it is in the red, it is an uncomfortable feeling, but knowing, you're working with an advisor and you have a long-term focus and play in mind, that's what we're going for. So business cycles happen and there may be volatility, but maybe training your brain to say, okay, I'm in it for the long haul. And, if you're not in it for the long haul, then you also should be speaking with your advisor about that to make sure you're positioned for the sort of appetite for risk that you have.
Yeah. And you have to kind of take a look at, when you're, if your account's down, why is it down?
Right.
We always ask the question, why? Well, why is the account down? Well, is it something that fundamentally the economy is not producing as well as it normally would, and we're going into recession? Is there a reason behind that? Meaning, is there a war? Is oil supply been disrupted?
Are there exogenous shocks? Is there a
Right.
pandemic? Things like the pandemic can
Exactly.
have a huge effect.
Yeah. So, or is it just kind of a normal business cycle that,
Right.
we're just kind of slowing down and kind of revamping?
Right.
So that's kind of where I start with is when I look at downturns in the markets, it's like, okay, why is this happening? I mean, look at 2000, 2001, 2002 is a really good example. In 2000, we had just come up from 99, 98, 97, 96, really some of the best years up until that point in time that we had ever experienced. And in 2000, the dot-com companies were really starting to take off, prior to that in the late 90s. We get to 2000. And, they started doing a deep dive into a lot of these companies and turned out that they didn't really have anything more than market share. They had a lot of computers and they had a lot of market share, but they didn't really have tangible assets. So the market kind of corrects and goes down simply only 10%. Not that big of a deal, right? We go to 2001. We have a few companies that go out of business. They go into bankruptcy, and with scandals. One of them was Enron. Another one was a company out of Philadelphia. It was a cable company that had a bunch of fraud in it, and they went belly up. A company by the name of Adelphia at the same time. So there was a lot of problems that the market went through. And then we get to September. And we've got terrorists that are blowing up, taking airplanes and putting them into buildings, and a lot of people died. It's the biggest disaster since December 7th, 1941, when the Japanese bombed Pearl Harbor. So that market obviously doesn't like that, so it goes in, recedes down 13%. So now we're down 23% after 2 years, and we start January, and everybody says, "Oh, no, we've never lost 3 years in a row." And yet we end up with this war on terror that is everywhere, and it's impacting our lives. We kind of go into a pivot down a different path, and the market doesn't really like that at all. We go down an additional 23%, 46% total. Now, the interesting thing is that, yes, it was bad. Yes, it wasn't very fun. Yes, I've lived through it. But the problem, we went down 46%, but we also made up that ground. We obviously kind of slide into 2008. Things get worse before they get better permanently. And there's lots of reasons why 08 happened that we're not going to go into. But my point is that go back and take a look and see where the market was at 2000 and look where it is today. When I say the market, I mean either the Dow Jones Industrial Average or the S&P 500. Okay. Significant differences. To where we are today to where we've become. Markets genuinely move forward about 70% of the time, and basically about 30% of the time they recede backwards. It doesn't mean you're going backwards all the time. Or it's like, hey, you took 7 steps forward, now we're going to go back 7 steps. You might go back 5 or 6, but you still taken 2 more steps forward.
Right.
So, I mean, to put it in simple terms.
Right.
So,
yeah, I mean, we are averse to loss. That's just like the human, psyche is just seeing a gain on your screen versus a loss. Like
right.
the losses we're getting calls when accounts are in the red. We are not getting calls when they're up, more than $10,000 at a
Right.
time. So it's just kind of human nature. So another sort of like behavioral finance term that we see is recency bias. And what the definition of recency bias is that we assume whatever is happening right now will continue to happen. So to your point just now is, will that continue to happen? Maybe, but historically not for forever. So, where we see, example of this is like, okay, the market drops. Oh my gosh, the sky is falling. What if this keeps going? But if the market's up, we're like, this is great. More, put in, more. So it's kind of like, we're going to have that sort of mentality of like, oh my gosh, the sky is falling, like, halt, stop the presses up, like, don't do, panic.
Right.
Or the market's going good. This is gangbusters. This is awesome. And so it's kind of like whatever the market's doing, you're just kind of having that recency bias of like, oh, okay. And we saw that. I would say, we did see that in 24, 25, like markets were doing pretty gangbusters. So people who call us assume if I put money in, if they're a brand new investor, if I put money in, like it's going to grow because
Right.
it has for the past couple of years. And it's like, well, not necessarily.
Yeah.
It can drop.
Yeah.
We've seen that this year. It's going, up and down, up and down. So I think people need, to realize with the recency bias, like just because it's happening now doesn't mean that will continue to happen per se.
Agreed. And I just got done reading. I'll give Andrew Ross Sorghum a plug for his recent book, 1929. It's an excellent read. So I really encourage everybody that's out there listening to pick it up and read it. And he basically talks about the crash of 1929, what led to it, and what was the sentiment. But just going through the numbers in the Dow Jones Industrial Average of basically 30 industrial companies, the stock market, in the Dow in September of 29 basically peaked, and by 1932. It had fallen basically about 89%, and it really didn't recover until 1954, November of 1954, which is really a very, very long period of time. Obviously, we've got World War II, we've got the Great Depression, and then that springboards into World War II. So it had been a while. There's no question about it. Now, what I don't know is that if we have the same number of companies, or the actual same companies rather,
Right.
in the Dow during the 1929 crash that were there in November of 1954, there may have been different ones, and they do change from time to time. The point is, however, and this is pointed out in the book, but there were so many things that were different back then that we just simply don't have in play today. There wasn't any rules or regulations. There was no SEC. There was no rules on speculation or margin, as is commonly referred to. I mean, you could speculate back then up to 90%. So if stocks are trading at $100 a share, you could, for $10, you could go get a stock and you could borrow $90 and with very little exposure, very little down. Just your $10.
Yeah, the margin requirements were not high.
And it was like the Wild West. There was no regulation. There was no nothing. Today we don't have that.
Right.
So there are rules, there are regulations.
Yeah, things like the FDIC. We have SIPC coverage on investments.
Big time.
We talked about a while ago ERISA,
Right.
coverages and things like that. So,
but because we've either talked to people that were living at that time, grandparents, great-grandparents, we've read in the history books growing up and in high school and in college. And so there's always this mystique that there's going to be this next big, huge, hairy monster that's going to be the next 1929. And I just don't believe that it's going to happen. I'm of the opinion that, with diversification, that's another thing is that there wasn't as much diversification. People were investing in just individual stocks, mutual funds. The Investment Company Act of 1940, which really is where mutual funds came out of, obviously wasn't really in 1929. So you didn't have a lot of diversification in a lot of portfolios. There's
high
a lot
risk, high reward, but
Yeah.
high potential for loss.
Exactly.
100%.
And so, yes, we are going to have turmoil. Yes, we are going to have drops in the market, and sometimes they could be severe.
Right.
But I don't think that we're going to see a situation where a break even, is basically 35 years before you get back to to level playing field.
Right. So that recency bias, it's not really, it's kind of like a paradox. It's like, oh, whatever's going to keep happening, whatever's happening now will continue happening or vice versa.
Right.
And that's not always true.
And I just don't think that, markets, even going back to the turn of the century, going back to, 1900, it's 125 years of data, recession length time is still at 14 months. Which is pretty amazing.
Right. That is amazing.
So expansions have gotten, obviously, if you're looking at recessions versus expansions have gotten a lot longer. But even going back 126 years of data, the average length of an expansion is about 49 months, whereas the average length of a recession is 14 months. And this comes from JP Morgan, their guide to the markets, which is where this data is coming from. JP Morgan does an excellent job of, really deciphering history and peeling apart the onion in some of these statistics. So
looking at history is extremely helpful to kind of like train your brain.
Right. Now, and I'll put a plug into, all the regulators that might be listening. Past performance does not equal, future results.
But it rhymes.
Yeah.
Right.
So
the next behavioral finance term that we see a lot is herd mentality.
Yeah, this is a big one.
And the definition is we as humans tend to follow what others are doing, especially in uncertain situations. So, if you see headlines, you turn on the TV and there's the sky's falling, right? Social media, especially now, we can go on our phones and everything's at our fingertips. Group chats. What are your friends doing? You're at a dinner party. What's everyone else doing? Oh, well, Joe Schmo down the street's getting, he's getting a 35% return or 50% return. And what am I doing? So we want to always kind of follow what other people are doing. And I've seen this in like the meme stocks, like all of a sudden people are pouring money into one stock and the next day they're like dumping the money out. So we're kind of just following these like groups of people versus just staying consistent. So big waves of buying or selling just based on news cycles or headlines is just it's in our nature to want to follow the forged path or follow a group, because then what could the risk be if we're all doing it? But obviously that's not always accurate.
There's an old famous saying that the baby's being thrown out with the bathwater, and where it comes from is that herd mentality.
Yeah.
We've seen this so many times throughout history where excellent companies with excellent management, excellent cash flow, excellent tangible assets are being reduced simply because they're in an industry that's being reduced, or the entire market's going down. So, Ford Motor Company might be as an example, been around for, over 100 years, fantastic company, great management, great cash flow, but they may be, being thrown out because the automotive world is being thrown out. So, that's just something that happens. You just gotta, if you're a stockholder in Ford, you're like, well, wait a minute, is the management changed? Has the company assets changed? Are people stopped buying vehicles? And the answer to all three is no, of course not. So, that's just one company and one example, but there's thousands of them out there where we see just, because of, well, everybody else in their industry group is going out, they're going to go out too. And it's just not the case.
Or just investors, individual investors in general, following the group think or, the herd mentality of, everyone's going to go buy this certain stock, so I'm going to do it too. And
Right.
I'm going to sell it when they tell me to sell it. And it's too risky and typically doesn't really work. So herd mentality, that's, and we get in client meetings, oh, this, a group of my friends are doing this investment opportunity. We're doing,
Bitcoin
yeah.
is a classic example of herd mentality. I mean, everybody's, oh, what's Bitcoin?
Yeah,
What's Bitcoin?
everybody's
I
questioning about
gotta
that.
I gotta get some Bitcoin.
And
It's
I'm
like,
very indifferent. It's just a commodity, but I'm like, okay, doesn't mean you should put everything in it
right.
overnight because everybody else is.
Right.
I mean,
Or
come on.
silver or gold. I mean,
Right.
yes, some of these assets have done very, very well in recent times.
Right.
Does it mean that you should take your portfolio and revamp it to some of these? No. It's even Bitcoin now, that's because it's been legitimized by President Trump, through the Federal Reserve System. It now becomes an asset class, no different than any other asset class.
Right, right.
And so it's like, well, would you put everything into wheat or pork bellies, or would you put everything into corn? Of course not. Well, yeah, I mean, corn could be doing very well.
Right. But the herd mentality is there of everybody's doing it. Everybody's making $1 bazillion.
Yeah.
And, that's not always true.
And
I'm
I
not saying it's a bad investment. I can't recommend that or say what's, one size fits all, but it is definitely that herd mentality where you see it out there and it's so popular that everybody always wonders about it and wants it.
Well, and going back to the recency bias is instead of the market going down, it could be going up.
Right.
And
well, it's going to continue to go up. It's going to, and
right.
That's not necessarily true.
Exactly. And that's
Especially
where
right.
that herd mentality kind of falls in line with that.
Right.
Because, everybody else is doing it. So everybody, they got to know something that I don't. So it's a good thing.
Or celebrities are doing it. Like we see all these football players.
I know.
They're doing the, Bitcoin, or I'm doing this investment opportunity, or they do, commercials for different investment funds or investment vehicles or things like that. And that's a herd mentality too of like, oh, well, the rich and famous are doing it, so I'm going to do it.
Right.
Well, they're likely getting paid to do it.
There's another old saying, what would a prudent, it's actually, it's a rule. It's called the prudent investment rule. What would a prudent investor do?
Right.
Would you go chase the hottest and the greatest and the latest, or would you simply build a portfolio that's well diversified,
right.
that's built, to last over a long period of time?
Right.
Which is something that we obviously do on a daily basis.
Of course. So the next, and there's tons of psychological or behavioral finance terms, but the last one we'll highlight today is overconfidence. And that's defined as when things are going well, we overestimate our ability to predict or control outcomes, i.e. strong markets, more risk taking. I've got this figured out mindset. Yeah,
this again is we think that there's angles, or we think that we're going to be, it's to coin a phrase from the book, the smartest guys in the room. I mean, it's like, you're not. And again, I'm a big, tortoise and hare believer. The slow and steady win the race. The latest and the greatest don't. And there's just a well-diversified portfolio built over time that you're constantly adding to, taking advantage of, which is what many people do in their 401k plans, is going to withstand. It's going to stand the test of time, and it's going to withstand a lot of, turmoil that's going to come their way. I mean, if you're in a 401k plan, you're contributing every single pay period, and the market goes down 20%, you should be like jumping
for
up
joy,
100%. You should be like, oh my gosh, everything is on sale. So the real market magic doesn't happen when the market goes up. It actually, when it goes down, if you're contributing,
1,000%.
Because you're gaining so much more traction. So when it does come back up, you now own more of that mutual fund. You own more of that portfolio than if you would if everything stayed the same.
Right.
So
right. I was having a discussion with a client who has, a concentration sort of discussion of concentration in a certain stock.
Yeah.
And, oh my gosh, well, it's done super well, and this company has all these plans to do this, this, and this, and it's a certain EV maker that we were discussing that we all know, and see in the news, and while I'm like, okay, yeah, they're like, oh, I think I got this figured out. They've done super well over the past, 5-10 years. And I've really done something because I bought it at the ground level and now, here's this. But I'm like, but we don't have a crystal ball. Like we don't have this figured out.
Right.
And while all the people on the news will try to make you think that they know better, I'm sure there are people, I know there are people like CFAs and people who are like trained to figure out the data and be able to forecast the future. But like in the end, there's shocks and things that happen, like we've said, where we don't have a crystal ball.
No.
So if that certain company goes to zero, where does that leave your portfolio?
Right.
Like just because you've done well over the past 10 years does not mean that you've got it all figured out and this is the company that's going to take us to the moon. Like we don't know.
Right.
To a point. I mean, we have, again, history can show us, but it doesn't, mean that that's going to happen moving forward. And we don't have a crystal ball to say. So you need to have, a well-diversified portfolio.
Yeah, and that's a key right there because Dave Ramsey used to put this on stage. It was pretty cool. He had these tall glass cylinders, and he would take it must have been paper machete or something, paper mache, I guess what you call it, where it was like an egg, and he would basically drop the egg. And it would disintegrate. And he's like, this is what happens when you have everything in one company. And then he lights up the rest of the stage and he has like all of these cylinders with all of these like smaller eggs. And there's probably 50 eggs in each cylinder. And he's got 10 cylinders. And in one of those is a red colored egg that's the size of a grapefruit. And it basically, he picks it up and smashes it. And he's like, this is the same company that went belly up, but you have like 400 other companies that you're investing in via mutual funds. And so you're gaining all this diversification. Your portfolio is not been affected by it hardly at all.
Right.
Whereas if going back to Enron, if you put everything into Enron, which is a lot of what they said to do, which is a horrible idea, people lost everything because they were invested into one company, and it was beyond their control. They there's a lot of fraud that happened in Enron, and but the average investor doesn't know that. He's not sitting in the board making those fraudulent decisions, so. He has no control over that. Yet he put everything into one basket. So into one company. So that's what we don't want, and that's what diversification can eliminate.
Right. And so it's just kind of like, so that overconfidence, that behavioral way that we, I've seen growth already, so it's going to be, or I figured this out, is kind of like, it's not always true. So it's really not just about the market. It is in a way, but it's more so, how we respond and how as humans our, psyche works and how we're actually wired to respond to it and how that can naturally lead to mistakes, our own mistakes.
Right.
So let's transition here now, when we see volatility, like, it's in 2026, we've seen nothing but volatility. At this juncture in time, the markets are up, but
they're very choppy.
We know that they're choppy. So to kind of guide our listeners and people through this, we want to talk about what not to do, in times of volatility, and then what we do recommend to do.
Right.
So let's start with what not to do.
Well, and this is, I mean, obviously we don't want any panic selling to lock in losses. We're not trying to time the market. We want to, kind of stay the course. And this is, a study that was done by JP Morgan. I saw this and I'm like, wow, this is just so perfect for this topic. They did a study as to the 10 best days in a year, and then what were the 10 worst days in that year, and what was the time frame in between the two. And what they found is that 6 of 7 of the 10 best days occur within 2 weeks of the 10 worst days.
Yeah.
I mean, think about that for a minute. I mean, it's like, hold on. So it's like 7 of the market's 10 best days occurred within 2 weeks of the 10 worst.
Yeah. I believe it.
I mean, I do too. But my point is that when we think that the market is permanently, and it goes back to that whole 1929 mentality of like, oh my gosh, the sky truly
right.
is falling. That, I mean, it's like, okay, we've had some bad days, and all of a sudden the market, and we've seen it this year. We've seen that V pattern where markets have really gone down. We saw it actually last year in April.
Yeah.
When President Trump announced that he was putting tariffs on, and the market completely flipped out. Everybody went crazy. Oh my gosh, this guy's falling. These tariffs are going to be so expensive. Yeah. It's going to be inflationary. He's crazy. He's a madman. What's going on? And then all of a sudden, like by May, it was like, oh, well, okay,
Yeah, I think we saw a
back to normal.
7% drop on one Friday in April last year.
Yeah.
And even, I mean, I looked at it and I had a pit in my stomach.
Yeah.
But then if you can look back at that stat.
Yes.
7 of the markets, within 2 weeks, 70%
we were right back to where we were.
And then some.
Yeah.
So I think as investors, instead of succumbing to that sort of behavioral finance, like, oh no, the sky is falling, it's all, we need to sell out, we need to get out and run and hide, really just look at what history has done and fall back on your investment plan. And if you don't have a long-term focused investment plan, you need to get one.
Yeah, you need one for sure. And I think the key there is that diversification is so important.
Yeah.
Step
like
back and go, why is the market going down?
Yeah.
Okay. So Trump put tariffs in. Okay, what's that impact going to be? Mm-hmm. And then all of a sudden, the next day he comes out and says, we're going to have this 15% tariff. Then the next day he's like, well, we're going to have a 15% tariff for some companies, but not for others. And then he's like, well, we'll put a hiatus on for 60 to 90 days. Mm-hmm. Market goes right back up.
Right.
I mean, and now we've had between 15, we're actually, because the Supreme Court ruled against him recently in the whole tariff thing, we've gone from, according to JP Morgan's Guide to the Markets, we're at 15% tariff. We're now at about 12 and a half. And that's been since August. Yeah. And the funny thing is that the market actually has done pretty well from today to back to August of 2025. Right. So that includes the tariff. So the market got kind of hip to, well, this is really kind of a negotiation style with Trump. Some companies are going to pay, some aren't. And like I said, the Supreme Court has ruled against part of this, so he's going to have to pay back some money.
Right.
Which is totally fine. But my point is that we're still consuming, according to the guide, at around 68% consumption. So inflation numbers as of the end of March show core inflation, which removes food and energy. It was created in the 70s. Went from 2.5 to 2.6. Mm-hmm. So the Fed, back in 2022, we had runaway inflation at around 9%. The Fed came in and said, oh my gosh, we got to raise these interest rates. And we went from 1/4% to over 3. I think it was like 3.25 in 6 months. Markets went crazy down for a little while. But my point is that they wanted that target rate for the inflation to be under, be under 3%, somewhere in the 2s, and that's where we are today. And we're still consuming at 68%. Yeah. So it's like, well, wait a minute. If we've got all these high tariffs, how is it that people are buying stuff? And the answer is there's still a lot of money floating around in the United States of America. Things aren't all doom and gloom as we've all led to believe.
Right.
And so
all of that to say, I always advise against panic selling.
Correct.
And we get calls all the time. Oh my gosh, the sky's falling. Unless we truly need to have a rehaul discussion of the portfolio, which 9 times out of 10 we don't need to have.
Right.
If there were maybe some cash needs we were unaware of, where they can't afford to lose any money or be down, where we have to, have a more capital preservation sort of tailored portfolio. We don't advise to sell. That's a knee jerk and that's a panic sell.
Right.
So when you panic sell, 70% of the time, within 2 weeks, you would have recouped those losses.
Right.
And I put losses in air quotes because you haven't lost until you sell.
Correct.
So panic selling, avoid that, because, there was a couple of people, this year so far where we're like, just wait and see for a couple of weeks. And then boom, they called us back happy as a clam 2 weeks later.
Right.
Oh my gosh, you were right. Thank you for, stopping me from doing that. So
Right.
when markets are choppy, stay the course, keep your plan in place.
And again, why is the market choppy?
Right.
Okay.
I mean, they're responding right now. We're in, having the war happening.
Right.
So the market does react to headlines and war and shocks, pretty quickly.
Oh, yeah.
And so as investors, maybe not having knee jerks like the market does is where the magic can happen as well.
Well, yeah. I mean, is it an overall trend? Obviously, speaking of the war in Iran, obviously, if the Straits of Hormuz are shut down and there's no oil getting in, there's no tankers getting in or getting out, and we've got a global meltdown of energy,
Oil,
because 80% of, especially in the Far East of that, in that area, rely on that oil coming out of the Straits. So if that's shut down, markets aren't going to like that. There's no question about it.
And gas is going to be real expensive.
Gas is going to be very expensive.
Myself.
Yeah. And so things are, you're going to have inflationary impacts, and you're going to have, a global, kind of meltdown economically because oil is everywhere for a short period of time. So, but if the reason that we're going and creating, or we're seeing all this choppiness, is that war, and they say, oh, we're going to have a ceasefire, markets reacted immediately.
Right.
And so you always have to step back. That's why I always kind of say, okay, is this something that's just kind of news of the day, or is this a long-term trend?
Right.
Now, obviously, if the Straits are shut down for a long period of time, that's not going to be a good thing, okay? But if it's something that, well, some ships are getting out, there is some oil coming out, or there's a ceasefire, so now everybody's good to go. There's a blockade, but everybody, I mean, they are working out a way that we can continue to have energy, leave the area, and so on and so forth. So, again, is it a long-term trend that is going to happen? Obviously, with COVID, we saw a longer-term trend with supply chain. And so that created some problems for a year or two, and we had inventories low, and we had supply chain issues and things of this nature. And so a more long-term trend occurred. Interesting thing, we technically didn't go into recession during that time period. Which is, markets fluctuated quite a bit, and there was a lot of volatility, but man, oh man, we still didn't have this doom and gloom long-term 20-year cycle where you're going to have a real problem. I just don't buy it.
Foresee it.
Yeah. I just don't buy it. And so you have to kind of step back, take a deep breath, and go, why is this happening?
Yeah.
And
recognize, why do I have a pit in my stomach, or why am I having a negative reaction? And maybe that's a revisit to your risk tolerance or your appetite for risk with your investment advisor.
100%.
And we always say that to people. Well, we could, let's open this up and talk about it.
Right.
And then, usually we say, let's, wait a couple of weeks and see how we feel.
Right.
Versus, having a knee-jerk reaction. And, a lot of the time clients want to time the market. And that's just something, we don't do with long-term focus. You're not going to time the market. You're always, not always, but I would say a very high percentage of the time, you're going to finish last because you're trying to make short-term moves versus just letting, the compound interest and compound growth work for you.
Right. And, you could be an older investor and want
there are times where you have to tailor a portfolio to the runway or, the runway we have for growth. Right.
And so you may be an older investor that you don't want to take, those kind of wild swings. So you want something a little bit more toned down. Maybe you want a buffered strategy to help, buffer some of those losses.
But those conversations happen with a really good investment advisor like us that can really temper your expectations and figure out the sweet spot that fits the client.
100%. Yes, absolutely. Absolutely.
So we talked about what not to do. Don't try to time the market.
Yep.
Don't, try to, over checking your accounts is a huge one.
Oh,
like,
God,
I always say, like, maybe, like, check your accounts. You want to know what's going on. You don't want to like be like this, but like, don't be checking it every single day. This is a long-term focus.
Right.
Like if you're my age, you're not retiring for 30, 40 more years.
Yeah,
so,
yeah.
You don't, checking it every day doesn't really make sense. I would just say, maybe every month look at your statement or every, once a week or so, but I wouldn't overdo it and give yourself anxiety.
And well, the other thing is that if you are, I would say even under the age of 55 or even 60 and you get a downturn in the market, you really should be doubling up on your contributions,
Right.
looking for ways that you can add more money during this volatile time. We do go backwards. I mean, it is going to happen. Okay. I don't think it's going to be a permanent drop. I don't think we're going to see an 89% reduction in our markets. But, on average, recessions, happen about 14 months, and the average decline is about probably around 30% during that time period. So if you're younger, someone like yourself, man, oh man, what a buying opportunity. You guys get every penny you can muster and get it into the account so that you can take advantage of it.
I have a couple of great clients where we have, if there's a couple of down days, I always get a call. Here, I'm sending more. I'm sending more. And I always smile because I'm like, that's
they
like
get
ideal.
it.
Yeah, they get it.
Exactly. That's what you really want to. Instead of going like, oh my gosh, the sky is falling, you're like, you should be licking your chops going, man, oh man, look at this opportunity. Here's more money. I'm buying everything on sale.
Yeah. So what you do instead, revisit your goals. Maybe turn away from the headlines for a minute and revisit your goals. And that's a great time to sit down with your financial planner, like myself, and say, what are our goals at and what is our portfolio at? And like, are we on track for that? Even though, we may be seeing some down markets. And then, if nothing has changed or you're on track, stick to your strategy. And like, that's also the strength of a really great financial plan is like knowing that we've run some Monte Carlo simulations. And if you don't know what those are, call me because I can help you run some. But we know that like our portfolio is positioned to take these, the volatility.
Right.
So that's your comfort should lie in your strategy and your strong financial plan with your amazing financial planner like me.
Yeah.
So this could be a time for rebalancing, just cleaning up your asset allocation. We've been doing a lot of that lately where, we're just kind of cleaning up, fine tuning, and then continuing contributions. And to your point, maybe even dumping more into your accounts.
Yeah. Yeah. I mean, I always look at this as with market changes, is using a sailing example. When you're out, at sea and the wind starts to blow and you're getting a storm and there's some real problems with the weather, one of the things you can do is you can reduce your sail area. So you put in what's known as a reef. You can even put in a double reef. But what you don't do is like take all the sails, fold them all up, and just sit there and drift.
Right.
And let the storm carry you where it wants to. You're like, no, I mean, I gotta continue to fight through the storm. So I'm gonna have to have a little bit of momentum, which means that I'm gonna have to have some sail area up. And it's a great example because you're still going the direction that you want to go. Right. You're still focused on getting from point A to point B, which is what your retirement plan is. So it's a great analogy to I've used on many, many times with many clients to basically say, hey, we might fine tune a few things. We might, put a reef or two into the mainsail, maybe drop a sail here, but we're still not going to go run to, port and just sit there in cash. I heard a great statistic that JP Morgan had said that a 60-40 portfolio, and I've talked about this so many times with clients, they probably heard this and go, oh my God, here it comes. But it's so good. A 60-40 portfolio.
And that means, for people who don't know.
Yes.
What does that mean?
60% in equities or stocks, 40% into fixed income or bonds typically.
Yeah. And if you don't know what stocks or bonds are,
call us.
Call us or go to our Instagram. We have a vocabulary school series where we talk about finance vocab.
But anyways, a 60-40 portfolio beats cash. And this was done by JP Morgan, one of their heads in the regions. A really sharp lady did this study. And she basically found that a 60-40 portfolio beats cash 100% of the time after 10 years. Not a big surprise there, okay?
Yeah,
you expect that, right?
Yeah.
60-40 portfolio beats cash 80% of the time after 1 year. I still don't think that that's that big of an alarming statistic, okay? I kind of expect that as well.
Not shocking.
This is the one that blew me away. 60-40 portfolio beats cash 60% of the time after 30 days.
Yeah, that is literally 1 month.
Yet, I mean, and you're beating it 60% of the time.
Right.
You know, and
huge.
it's absolutely huge is not a word to describe in my mind how big that statistic really is.
Yeah.
So that kind of tells me everything I need to know right there about running and hiding versus making some adjustments. Like I said, with this sale example, maybe you got to put in a reef. Maybe you got to take this sale down. Maybe you got to, go to a stronger sale or something like that.
Wait, what's the word where you have to zigzag instead of going straight?
Tacking.
Yeah.
Maybe you have to tack a little bit more.
See,
but
I know the sailing lingo.
There you go. But it doesn't mean you just go run and hide. And if you're young and markets get really goofy, that is such a big opportunity to add more.
Like, that's good. You want that to happen.
Yeah, that's what I said. That's where the real magic is.
And it's our psyche that doesn't allow us to see the light at the end of the tunnel.
And then the other big thing I think is in the last what to do as far as a plan is have a conversation.
Right.
Okay. More communication, the better. So talk to your advisor. And if your advisor's not talking to you, pick up the phone and call us.
Right.
I've had conversations with clients that basically says, hey, we get to a consensus. We're not going to do anything. Let's reconvene the conversation in 2 weeks.
Right.
And then I call back in 2 weeks. How you feeling? Well, feel pretty good. The last 2 weeks.
I'm glad we didn't sell.
I'm glad we didn't sell. Okay, great. Let's have another conversation in a couple weeks. And these are things that your advisor should be doing. This is something that you should reach out and as a client with an advisor, this is what you're paying for is that expertise and guiding you through difficult times.
Yeah, and helping you take sort of the emotionality or the behavioral finance aspect out of it, and creating a plan. Your plan should guide your decisions, not your emotions and your knee jerks. Honestly, so
1,000%.
Yeah,
markets will always be volatile. It's the nature of the markets. It's that given moment, how it's going to affect that particular company with these given circumstances, whether that's good or bad. And the speculation of, we got a problem with oil. Oh, well, then that means that this company is going to have a real nightmare. So the stock is going to go down.
Right.
But it doesn't necessarily mean that that's a bad company.
Right.
Okay.
Right. Or it could be, but at least your portfolio is diversified. So
right.
It's not
and if it is, you're not going to get wiped out.
Right.
But
you're not going to ruin your retirement.
It could be a great company with great management, with great cash flow, with great tangible assets. I mean, it's an entirely. You've got to look at that big picture.
Right. It's always the big picture. So markets have always been volatile. Recovery is always part of the cycle.
Yeah.
Long-term investing requires patience. And I've said this before, and then I saw another metaphor I want to mention. Investing and building wealth is like watching paint dry.
Yeah.
So it's patience.
100%.
And then I also saw something that said, look at your portfolio or have a long-term focus instead of using like binoculars. Now use like a telescope, like you're looking way far off into the distance.
Right.
And that's truly like, and that was from Karen Ross. She
I like
VA.
that.
I loved that she said that. She commented that on one of our videos, that I just loved it.
Yeah.
It's just long-term investing requires patience, and really discipline comes out with, more than, timing the markets or, having knee-jerk reactions. So always keep that big picture perspective, and talk to your investment advisor about it.
Yeah, I always say, volatility is a part of investing. There's absolutely no question about this. I always say, look, you're going to walk across the floor about 5 or 6 steps, and then you're going to walk back 1 or 2. And then you might walk forward another 7 or 8. And now you might come back maybe 5 or 6.
Yeah.
But eventually you're going to see yourself across the floor. Okay? You're going to like, wow, I've walked from point A to point B. And yeah, you've gone backward. Does it suck going backward? Yeah, it's not fun.
Yeah.
No one likes it, but it doesn't mean that it's going to be permanent. It's not going to take 35 years to recoup, losses. It's just not.
Yeah. Yeah. So, and this is exactly why behavioral finance is such a big part of financial planning in general, and facilitating those discussions literally about how we feel.
Yes.
And sometimes, when I'm sitting around the round table with our clients, it can, we like to talk about, like, how comfortable are you? What does make you nervous, in terms of like market volatility, but also like, in terms of your money or your retirement. And that's where, it becomes such a big part of the conversation with our planning. And it's not just about picking investments. It's really about helping people make informed, good decisions when it matters the most. And sometimes it matters the most in times of volatility.
Yeah. And then that's, when you have a diversified portfolio, when you have an advisor that you're communicating with on a regular basis, and you're taking the right risk, you're really bulletproof at that point. I mean, yes, you're going to experience some temporary losses. But, again, like I said, markets move forward more than they move backwards.
And there's lots of solutions out there that we help our clients with to protect them in some,
Right.
capacity. And I say protect very loosely. Nothing's guaranteed.
Correct.
But there are some really good sort of strategies that we have and can present to folks as well. So give us
Exactly,
a call.
especially for older clients that
100%. Who
that
don't have
are
that sort of
taking money.
runway.
Yeah,
Right.
I mean, anybody that's young, again, you really should be just jumping for joy when you see the market go down.
Yeah. Making contributions.
Because you're making these contributions, and that's how people our age, when we pull those big retirement accounts out, somebody that's 65 years as I am. We didn't care about what was happening 30, 40 years ago.
Right.
We just kept plowing money into the 401k plan.
Yeah.
Yeah, so what's changed today?
Nothing.
Same goes. So, so we want to have a goal where we're not avoiding these drops in the markets. They're going to happen, but we want to be able to feel comfortable to understand how they work. Markets react on, moment by moment news. That's short term. We're long term investors. And so obviously, long term goals, long term investment, they go hand in hand.
Right. Yeah. And so the goal is to just be prepared, have a plan when things feel uncertain. Because, if you're feeling uneasy about the markets right now, you're definitely not alone. But this is a great time to step back, make sure your strategy still aligns with your long-term goals.
And that's what really planning is, where planning makes all the difference, and having a plan.
An open dialogue too with your advisor.
And talking to your advisor, and so that they can, get you past some of these emotional times. I mean, markets are choppy. We've got an unexpected war that came out, which could affect, global oil.
Right.
That's a big thing.
100%.
So far so good, and I think it will be, but you never know.
Right.
And so you've got to be prepared, for all of that.
Right. So I think this episode is super timely. I hope it helped you. Share it with someone who might need a little reassurance right now. And if you'd like guidance building or even reviewing your individual plan, we're here for you. So give us a call, reach out to us.
100%.
Be sure to subscribe wherever you get your podcasts. Give us a follow on Instagram at RM Waiting Company. You'll never miss an episode, and there's awesome educational content there as well.
Yeah, 100%. And you really, appreciate you joining us. Again, more great stuff to come. But this one, I think is one that, this episode, I think is so very important, to listen to and maybe even re-listen to, because I just think that there's so many lessons that are built into the last 45, 50 minutes that we've been talking. And investor behavior is so very important. I was reading. I'll leave you with this other one, another plug from the 1929 book. One of the guys that ended up coming out of this so well was a big investor, and he actually normally wouldn't go the other way, or what they call short the market. He wanted the market to normally he'd want the market to go up, and but he had kind of a funny feeling, and he actually ended up shorting the market and made $100 million in 1929,
betting on the downturn.
Downturn. Okay. He was such a speculator. It was like a disease to him, because he ended up losing a couple of years later. He had gotten involved in wheat and in corn and other highly speculative assets, and lost all of the $100 million, and ended up
Tale as old as time.
Yeah, I know, and ended up committing suicide, like a couple of years after he had won all of this $100 million. I mean, it's just and I looked it up. It was like $1.7 billion in today's dollars. To put that into perspective,
it's staggering.
So speculation is something that we don't do. Slow and steady wins the race. Diversified portfolios, that you stand the test of time. And staying disciplined and being that prudent investor. That's what this is all about.
100%.
So
thank you so much for joining us. Until next time, keep wading through it all with us. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.